Hey guys, in today's video, I'm going to show you how to use the stochastic indicator to maximize your success and avoid common mistakes traders use when using the stochastic. Let's get started. The stochastic, one of the most commonly used and most misunderstood and abused indicators by traders worldwide. Well, today I'm going to show you how to not make some of the common mistakes that traders make using the stochastic, how to not abuse it, and how to use it to maximize your trading instead of hindering your trading as it might have previously been doing. So we have to ask ourselves, what is the stochastic indicator? Well, the stochastic indicator is an oscillator similar to RSI, but there is some quite nuanced differences based on how it's calculated. The oscillator is used to measure momentum in a price, and we can use it to help identify the strength of a trend, to identify oversold and overbought positions when we're entering or exiting into a position. On a longer term scale, we can also use it to identify likely exhaustion periods in a trend when we're ultimately looking to sell or ultimately looking to buy into a new market. So the first thing I want to teach you is to differentiate yourselves between the 90% of traders who use the stochastic and don't understand how it's calculated, and I want to put you above the ranks of those traders by having a fundamental understanding of how the stochastic gets the reading that you see on your screen. The stochastic has three settings that affect calculation. You're going to have K, which is the look back period that you've assigned the stochastic to calculate within. You're going to have D, which is a moving average of K, and you're going to have your smoothing filter, which is going to change how many look back periods you're going to filter the current result through. And to explain that in more detail, let's go to the charts and look at a live example. So to effectively use an indicator, I think it is vitally important that you understand what it is measuring and how it is calculated. And that will put you in the top 5% of traders who know more than the 95% traders who are using indicators and don't understand what they're measuring and why they're calculated the way they are. So to get the stochastic in TradingView, you'll merely go up to Indicators, type in Stochastic, and it'll be your first selection here. Obviously, there are two other types of built-in stochastics on the TradingView platform and a plethora of public library scripts that you can play around with at your leisure. But for the purposes of this tutorial, we'll just be using the stochastic. So the first thing we want to do is we want to go to the gear icon and click Format so we can see the default settings of the stochastic. We see that the default settings here are 14, 3, and 3. Now, what do those correspond to? Well, K corresponds to the actual stochastic period that the calculation is being performed in, and that is designated here by the blue line. Now, 14 is how many candle bars, what period the calculation is taking place in. If you were to change it to 20, you'd be looking at a period of 20 bars. If you change it to 30, you'd be looking at 30 bars, and so on and so forth. D is a derivative of K, and all D is a 3-period moving average of K. So we can see that K lags behind D. So K is indicated here by the orange line on the chart, and K is a 3-period moving average. D is a 3-period moving average of K. And then our smoothing filter corresponds to how many look-back windows is our calculation being filtered through. So since the default setting is 3, we can see that not only is our calculation going to be filtered through this 14-bar period, but it's also going to be averaged out through this 14-bar period and this 14-bar period. It's going to be averaged out to the last 3. And to explain that, I'm going to get into the math here real quick. So what stochastic is measuring in a 14-bar period is the true high, the true low, and the close. So we see here in this example, this 14-bar period denoted by in between these yellow lines that I've drawn. We see that price reached a high in this range of $6,573.83 and reached a low of $6,520.22. And we're currently closing, the current candle closed at $6,547.03. That means that if we take the true high and subtract the true low, we get a value of $53.61. And if we take the close and subtract the low, then we're going to get a value of $26.81. We take the difference between the close and the low divided by the difference between the high and the low. So you see here we take 2681 divided by 5361, we get 0.5. Stochastic takes that value times 100 to get the value of the stochastic. So The value of the stochastic at this candle close is 50. However, since we're using a smoother, not only are we looking at this range, the difference between 53.61 and 26.81, we're also looking at this difference. So instead of just taking this high and this low, it's going to take the average of this high and this low, this high and this low, and this high and this low. So if I were to do the same calculations on these two bars, on this high and this low, and this high and this low, and then we averaged them all out, so we added them up, divided by 3, then we would get that value. We would take this value divided by that averaged value to get the smooth stochastic. So if you're seeing a little bit of variation down here in the stochastic, you can see actually that on this candle close, we're actually at maybe 54, 51, 54. The reason for that is that we're taking into account this big peak right here. So keep that in mind when you're using your smoother. Now you can change the settings. The lowest you can put your smoother to is 1, and that will that does mean that you're not being filtered through any previous bars, that you're just being filtered through this range of bars. Now, some people like that and some people don't. Some people think that it filters out noise. Some people feel that it detracts from them receiving accurate signals. So play around with these settings and find what works best for you in your time frame. Again, depending on the time frame that you're trading in, if you're trading on the 1 hour, 1 hour and below, you might find that a 7 period works best for you. And if you're trading on a higher time frame, you might find that a 14 or a 21 works better for you. So just again, play around with the settings as best as you can. Now let's see how we can use the stochastic to maximize your trading. Traditionally, the way that the stochastic is used in timing entries and exits is using it to identify overbought and oversold positions in the market. So the way that this is done, the oscillator, the stochastic oscillator, ranges from a value of 0 to 100. It can never go below 0, it can never go above 100. If the stochastic is at 0, it just means that price is at its absolute lowest within the look back period and the smoothed out filter as well. And if it's at 100, it's merely telling you that price is at the highest it could ever go. That price is at the highest it's ever been within the period that you're asking it to look at. Now, this obviously leads us to know that the stochastic cannot be relied upon 100% because we all know that price can always continue to go higher and price can always continue to go lower. So you have to be careful when using a stochastic not to blindly buy overbought and oversold positions, because as we can see here, when we see the market is trending upwards, we see that the market can remain overbought for a very long period of time. So the most common way of using the stochastic is identifying overbought and oversold positions in the market. So here we can see that the stochastic drops below 20 and is telling us that the market is oversold and that we might be wanting to look to buy. If we purchase here, we see that the market goes up, and we see that stochastic tells us that price is overbought, and we want to be looking to sell. So we sell there, and we take that profit. We wait for stochastic to enter the oversold position again, which it does right here. We drop below 20, and we're looking to buy. And we ride that up. We wait for stochastic to tell us that price is overbought, and we can sell right here. Now here's an example of where the stochastic may or may not give you the best exit positions. There might be alternative ways to look for exit positions that I'll go over here in just a second. These are the rules that I use when using the stochastic to increase my trading efficiency. I use the stochastic to pinpoint entry into a trend. The first thing you need to do is look at the asset that you're trading and identify the direction of the trend. Are you in an uptrend? Are you in a downtrend? Or are you in a sideways market? Because you will use the stochastic differently and look for different values depending on the market conditions that you're in. Now you can identify the direction of the trend with many, many different tools. A moving average is probably the most common and efficient. However, you could also use a trend line, Ichimoku cloud, or rising and falling volume. You want to identify overbought positions in a downtrend, and you want to identify oversold positions in an uptrend. Meaning, if you are in a downtrend, you are looking to short, and you are looking for overbought positions to enter into your short. And if you are in an uptrend, you are looking to go long, you are not looking to short, and you are looking for oversold positions for a good entry. Now, if the market is sideways, you can look to go long or buy, and short or sell, depending on oversold or overbought conditions. Then you use the crossover of the stochastic and the stochastic moving average, that D value that we had talked about earlier, also known as the trigger line, to time your entry. There is a more aggressive approach and there is a more conservative approach, and I will go over both. Let's go to the charts to see what I'm talking about. Let me start with showing you the common mistake that traders using the stochastic make. And the most common mistake I see is blindly buying overbought or oversold positions without an analysis of the chart that you're trading. So as we can see here, people blindly, most people using the stochastic would have bought here when the stochastic read oversold, indicating that they should buy, but that was not the good time to buy. They would have also probably tried to buy here, not a good time to buy. They would have tried to buy here, not a good time to buy, and they would have probably tried to buy here, all 5 times when the stochastic read overbought. Not good times to buy. Let's look at places where they would have liked to go short. They would have probably tried to go short here, and we can clearly see that's not the best spot in the market to go short. They would have probably tried to go short here, and as we can see, that's clearly not the best place to go short. And they might have tried to go short here, and as we can see, that is clearly not the best place to go short. They missed out on quite a lot. So those are common mistakes traders make, blindly buying the overbought and oversold positions on the stochastic. Let me show you what you can do with stochastic to avoid making those mistakes. So for our first example, we're going to be looking at Bitcoin in a downtrend. So what I have done is I have applied a 60-day moving average to Bitcoin, and we're going to use the moving average to determine whether we're in a downtrend or an uptrend in the market. So as we can see here, the moving average starts trending downwards, which lets us know that we are in a downtrend. And then we're looking, since we're moving to the downside, we are not looking to take trades to the upside with the stochastic. We are looking to take trades to the downside. We're looking to short. So we're wanting the stochastic to let us know overbought positions in the marketplace where we can safely enter into a short position. And you can see here that we reach overbought conditions right here, and we can safely enter into a short here, and we can ride that down to here when stochastic gives us a potential exit point here and a potential exit point here. Then the market reaches overbought conditions again right here, and we can enter into another short. Price moves down, and we can exit our short right at these levels when the market becomes oversold again. And then again, we get another opportunity to enter into a short here, and you could have taken that potentially as a signal, even though we weren't fully oversold. However, you could have re-entered into your short here, and then you could have effectively gotten out at these levels. Our last area to enter the short, which was probably the most profitable, is we could have entered into the short here, and we would have gotten out down here. So right there, stochastic using a moving average gave you 3 to 5 setups that you could have taken to safely trade the market to the downside for good profit over the period of about 5 to 6 days, and you would have been quite profitable. Our second example is going to be looking at an uptrend in Bitcoin. We can see that our moving average is moving to the upside, and what we're looking for is to take trades to the upside. We are not looking to short the market. So we can see our moving average starts moving up here, and our first opportunity to enter in to oversold conditions is right here. We ride that up, and we would have gotten an exit signal potentially here, but most likely we would have continued to go, and we could have exited here or here when the stochastic reads overbought. Then we're looking to take another trade to the upside. We can see here that there's a potential that you might not have entered this trade because the moving average starts turning, but we do become oversold again. And if you had entered here, you can see that you would have been able to exit here. You would have been able to enter again here, and you would have been able to exit here, here, or here when the stochastic reads oversold. You get one more opportunity to enter into your long trade here, and you get the opportunity to exit right here. So, again, same thing in an uptrend, 3 to 5 profitable trades over the course of a week that you could have taken using just the stochastic and a moving average. Our final example is going to be looking at a sideways market, and this is Bitcoin as we sit right now. So as we can see, when we're in a sideways market, we can look to take trades in multiple directions. We can take overbought conditions to the short side, and then we can immediately swap them out for long positions to the upside when the stochastic reads oversold. So you can see here that we start trending sideways. Market reads overbought. We can take the short trade to the downside. we can exit right here when stochastic reads oversold when we turn around, and we can enter into the long trade here. We ride it to the upside. We can exit here. You could enter into a short trade, which might not have played out for you. You would have broke even on this trade. But again, we reach oversold conditions, overbought conditions right here, and we're able to take that to the downside here. When we peak just below, and we can exit out of the short, enter into the long. Stochastic becomes overbought again, and we can re-enter into the short, and we move down. Stochastic reads oversold, we enter into the long. Stochastic reads overbought, we enter into the short. Stochastic reads oversold, we enter into the long, and so on and so forth. And we are soon about to, if you were playing this, you would soon be looking to exit your long that you would have entered into here, and you'd probably soon be looking to enter into a short based off stochastic. So in a sideways market, although it's slightly riskier than using stochastic to trend trade to the upside or the downside, you can use the stochastic to identify potential entry and exit points for longs and shorts in a sideways market. This is actually that last example with the stochastic setting changed from 14 to 7, and as you can see here, this is a better setting if you're looking to scalp the market this way in a sideways fashion. You get much clearer signals to the upside and the downside. Now, you can pause this video. I won't go over every single trade example. You can see that there are some losing trades here, and so it is important to utilize stop losses effectively. However, this does give you many more trade options on the table, especially in such a range-bound consolidating market. Hey guys, hopefully you know more now than you did when we started. I appreciate you joining me, and hopefully you can use the information contained within this tutorial to enhance your stochastic trading skills. Guys, head on over to crackingcryptocurrency.com and click join the community to get started in our Discord today to live chat with traders just like yourself and expand your cryptocurrency knowledge and your trading abilities. As always, I'm Justin Wise for crackingcryptocurrency.com. Trade safely.